Most people will never build real wealth from investing, not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. My name is William, and I want to tell you where this framework came from, because it did not come from a textbook. It did not come from a course. It came from observation. I spent years tracking stocks before they broke out, not after, before. What was present in the setups that worked? What was missing in the ones that failed? Hundreds of stocks across different sectors, different market conditions, bull markets and bear markets. Something became undeniable. Breakout stocks almost always shared 5 specific traits before the move happened. Not sometimes, almost always. The same 5 traits across completely different industries, completely different price points, completely different economic environments. That pattern became the clear framework, not a theory. Non-observation. 5 traits found in almost every breakout stock, built into a scoring systems, so you can measure conviction before a single dollar moves. CLEAR stands for catalyst, leadership, earnings, accumulation, risk and reward. 5 pillars, each scored out of 20 points. Total score out of 100. Today I am going to walk you through the 5 questions that map directly to those 5 traits. Here is something most investing content will never tell you. The investor who loses money and the investor who builds wealth are often looking at the exact same stocks, same company, same price, same news, completely different outcomes. The difference is not research. It is not intelligence. It is not even which stock they picked. It is whether they could answer 5 specific questions before they clicked buy. Most investors cannot answer any of them. They buy on feeling, they hold on hope, they sell on pain, and then they wonder why the results never match the effort. Question 1. What is the specific reason this stock is going to be worth more in 3 years than it is today? Not a theme, not a sector, not because your colleague mentioned it. A specific, named, verifiable reason. A contract, a regulatory shift, a product with no real competitor entering a market that is growing faster than the business can currently serve. If you cannot name it in one sentence, you do not have a reason. You have a feeling, and feelings are not a thesis. Most investors skip this question entirely. A buy, because the chart looks interesting, or because the stock is in a hot sector. Neither of those is a catalyst. A catalyst is structural. It does not disappear when the news cycle moves on. It drives the business forward for years. The CLEAR framework calls this the catalyst pillar. It is the first gate. No catalyst, no entry. Full stop. Question 2. What is the quality of the business behind the stock? Here is what most investors do. They look at revenue growth, see a strong number, and move on. That is not analysis. That is reading a headline. What you actually want to understand is whether the earnings are real. Is revenue growing or is the company cutting costs to manufacture a profit number? Is the gross margin expanding, meaning the business is getting more powerful over time? Or is it contracting, meaning competition is intensifying faster than pricing power can absorb? And the number that matters most, free cash flow, not accounting profit, actual cash left after the business has paid every bill and invested in its own growth. A business can report growing profit while destroying cash simultaneously. Free cash flow does not lie. If you cannot explain the quality of earnings in 3 sentences, you have not done the work. Question 3. Who is running this business and do they deserve your capital? Capital allocation is the most important job a CEO does. Every dollar the business generates has to go somewhere. The difference between a leader who allocates capital brilliantly and one who destroys it compounds dramatically over 10 years. Read the shareholder letters, not the investor relations material. The actual letters. A leader who communicates honestly about failures sees the business clearly. A leader whose letters read like marketing copy is managing perception, not the business. And check whether they own meaningful equity themselves. Leaders who own significant stock think like owners. Those who do not, often do not. Question 4. What is the chart telling you about where institutional money is moving? The investors who move stock prices are not retail investors. They are fund managers running billions. When fund manager builds a position, they cannot buy all at once. They accumulate over days and weeks. That accumulation leaves a fingerprint. Volume higher than normal on up days. Price holding support under pressure when it should logically be breaking. If institutional money is building a position, that is a tailwind. If it is exiting, that is a headwind. Knowing which one you are swimming with changes the entire risk profile of the trade, regardless of how strong the fundamentals look. Question 5. Does the math work before you enter? Entry price minus stop loss equals your risk. Target price minus entry equals your potential reward. Divide reward by risk, and you get your ratio. We only enter when that ratio is at minimum 2 to 1. For every dollar risked, we expect at minimum 2 back, ideally 3 to 1. Here is why this matters. Ken trades. Right 5 times. Wrong 5 times. 50% win rate. Most people think that is mediocre. But if your average winner is 3 times your average loser, you made money, even though you were wrong half the time. The math works in your favor by design. Most investors never run this calculation. They buy because the story sounds compelling and exit on how they feel. That is not a strategy. That is expensive improvisation. These 5 questions map directly to the clear framework. 5 pillars, each scored out of 20 points. Total score out of 100. 85 and above is highest conviction. 70 to 84 is high conviction. Below 55, we eliminate the stock and move on. There are always better opportunities. The next 5 episodes, we go deep on each pillar individually. Real examples. Named specifics. What strong answers actually look like versus weak ones. Amateurs buy stocks. Investors build positions. The difference is 5 questions answered honestly before a single dollar moves. Every Friday we publish the Friday Flash. Free. 1 stock evaluated through the full clear framework. 1 minute to read. Go to ProfitByFriday.com and subscribe today. I will see you in episode 2.